Airbnb stock a buy in February. The online vacation rental marketplace Airbnb, Inc. ABNB, does not have much upside remaining after doubling since its IPO on December 10th. The company has gained 22.9% year-to-date and is currently trading 17.1% below its 52-week high of $216. Given the huge damper the pandemic has placed on the travel industry, stagnating growth and weaker fundamentals could cause the stock to slump further this year unless the company invests more aggressively in customer acquisition. We think the following factors might cause the stock to underperform in the near term. Weak growth prospects. The coronavirus pandemic has placed unprecedented circumstances before the travel and hospitality industry. In fact, fears surrounding a second strain of the virus could thwart the industry still further and raise serious questions regarding the current and future survival of many industry participants. Although ABNB has a resilient business model that could help it navigate the pandemic better than its rivals in the industry, its future growth remains highly uncertain. With a devastating collapse in bookings and rental cancellations, the stock could take a hit in the coming months. Google's entry presents a challenge. In its S-1 filing prospectus, ABNB claimed that its SEO results have been adversely affected by the launch of Google Travel and Google Vacation rental ads, which have significantly reduced the prominence of the company's inorganic search results for travel-related terms and placement on Google. This has led to a reduction in visitors to ABNB's website, thereby preventing it from reaping the full benefits of internet traffic. This could be an important challenge for the company in the near future. Weakening financials. ABNB's revenue declined 18% year-over-year to $1.34 billion for the third quarter ended September 30, 2020. The company reported a net loss of $696.87 million and free cash outflow of $520.1 million for the 9 months ended September 30, 2020. Moreover, it reported an adjusted EBITDA of negative $230.2 million over this period. This can be attributed to COVID-19 headwinds and its impact on the travel industry. ABNB's lower than anticipated revenue, higher than anticipated operating expenses, and unfavorable changes in working capital could hinder the company's ability to reverse the recent negative trend in its adjusted EBITDA and free cash flow. Weak fundamentals. Even though ABNB has generated significant profit from its operations, as indicated by its gross margin of 73.5%, the company's negative EBIT margin and net income margin compare unfavorably with respective industry averages. In fact, ABNB's cash from operations in the trailing 12 months is much lower than the sector average of $188.73 million. Unfavorable analyst sentiment. Analysts expect ABNB to hit $156.31 soon, indicating a potential downside of 13.4%. The stock has an average broker rating of 1.8. Of 26 Wall Street analysts that cover the stock, only 5 rated it a strong buy. Ratings indicate potential downside. ABNB has an overall rating of C, which equates to neutral in our rating system. The ratings are calculated by considering 118 different factors with each factor weighted to an optimal degree. Our rating system also evaluates each stock based on 8 different elements. Of these elements, ABNB has a growth grade of C. This is consistent with its weak earnings growth potential. In addition, ABNB has a grade of D for value and momentum, reflecting the stock's relative overvaluation and weak price performance. ABNB's forward price to book of 17.68x is 401% higher than the industry average of 3.53x. In the 23 stock travel, hotels, resorts industry, it is ranked number 15. Bottom line. While ABNB has made some key strategic decisions that have helped it fare better than its competitors, some notable headwinds, such as the coronavirus pandemic, plummeting rental bookings, and losses in revenue and earnings, may heavily influence its future growth potential. However, we believe the company's resilient and capital-efficient business model could help it increase its market share in the long run.